Good morning, everyone. I hope everybody made it back in one piece from the Fireblocks AlgoTrader party last night. My name is Flury. I'm founder and CEO at AlgoTrader. We are the leading provider of digital asset infrastructure for financial institutions. Today, I will be talking about the various challenges banks face when offering digital assets to their clients and obviously also how to overcome them. As most of you know, crypto markets are highly fragmented. On one hand, crypto liquidity is distributed literally across hundreds of brokers and exchanges. And on the other hand, banks are missing the integrated tech stack to seamlessly automate the entire trade life cycle across core banking, custody, and trading. So as a result, banks today face many challenges when trying to offer digital assets to their clients. These include counterparty risk from having to deposit collateral on multiple exchanges and brokers. It's operational risk from manual asset transfers and manual client order handling. And then obviously it's execution risk during market stress situations when exchange APIs become unresponsive and blockchain transfers become slow. At AlgoTrader, it's our bread and butter to solve these challenges for our clients. And to achieve this, we provide a fully integrated and automated trading system. So what exactly is best execution in the digital asset space? Here is our definition. It's to buy and sell at the best possible price, but not only that, it's also at the lowest risk and cost. So throughout the next few slides, I will elaborate on the 6 main challenges banks face when trading digital assets. The first and probably most important requirement is market-wide connectivity. Being able to send orders to multiple exchanges, brokers, and OTC desks at any time has 2 main advantages. The first one is that it allows you to reliably execute client orders even if one venue goes down. You can just reroute your orders to a different venue. The other one is that it allows you to take advantage of lower commissions by taking advantage of market inefficiencies. One of them is, for example, crossed spreads. That means when the highest bid price on one exchange is lower than the lowest ask on another exchange, and that basically allows you to trade for free. And you can only benefit from that if you're connected to multiple venues. However, achieving market-wide connectivity is cumbersome. You need specialized order and execution management systems, and today most exchanges, brokers, and OTC desks don't offer a standardized API such as FIX. So you have to use custom adapters and need to connect to non-standard REST and WebSocket API used by most crypto exchanges today. And building and maintaining these adapters is tedious and error-prone and probably best left to specialized vendors. So as a consequence, if banks cannot or do not want to source liquidity from multiple venues, but instead limit themselves to a single or broker or OTC desk, they will not be able to achieve best execution, period. The second crucial requirement to achieve best execution is to fully automate the entire trading life cycle. Today, the biggest reputational damage and financial losses arise from human failure, such as fat finger trades and wrongfully entered deposit and withdrawal address. Automating the entire trading life cycle also reduces your headcount and operational cost, obviously. And as a consequence, banks today have to deal with this manual overhead, the operational risk, as long as pre-trade, trade, and post-trade processes are not fully automated. Number three, you want to make sure that your client orders are executed as fast as possible. Any delay means market timing risk. And as market conditions move continuously, it's necessary to find the venue that currently has the best price prior to routing an order to the exchange. This is exactly what a smart order router does for you. Also, you want to ensure that large orders don't move the market, and hence you need to use execution algorithms like TWAP and VWAP that split up large orders in a randomized fashion that are very difficult to detect by other market participants. Number four, one of the biggest entry barriers for banks when offering crypto trading is counterparty risk, obviously. Whenever you want to execute an order on an exchange, you have to pre-fund the exchange account and basically lose custody to those funds. Not your keys, not your coins, as we all know. In an ideal world, you would hold custody of all your funds right up to the very moment when you want to execute a trade to the exchange. The problem when pre-funding exchange accounts just in time before sending an order is market timing risk, as the price might have moved by the time your funds reach the exchange. So as a result, banks today often prefer to trade with brokers that can be quite expensive, or to trade with OTC desks that offer credit lines. Problem again, brokers may be quite expensive. OTC desks usually require quite substantial monthly trading volumes, which might be prohibitive for a bank that just gets started trading digital assets. Number five, so to benefit from best execution across multiple exchanges, each exchange account has to be pre-funded, as we just discussed. The amount of working capital that is locked on exchange accounts, therefore, increases with each and every additional exchange account that you're using. So apart from the resulting counterparty risk, this also significantly increases the cost of liquidity. In an ideal world, this multiplication of locked liquidity on exchange account would be kept to a minimum through a central liquidity pool. But this doesn't really exist today. Some financial service providers have already identified this need and basically give banks access to various exchanges while acting as a central financing counterparty. And obviously, you have partners like Copper and Fireblocks that offer services to instantly fund exchange accounts off-chain. Lastly, a still quite underestimated factor is execution privacy. If institutional wallet addresses have been identified by the public, it's actually easy for large on-chain transfers to be systematically identified and front-run by other participants. And this is actually something that's happening today. So if a bank or a large fund sends a transfer to an exchange, you can assume that that entity will be placing an order, and you can basically just front-run that trade, basically placing a smaller order before that big one hits the market. So ideally, it should be possible for banks to privately fund and execute orders prior to triggering on-chain transfers. So in order to overcome these 6 challenges, banks absolutely need a streamlined, secure, and private execution and settlement connectivity with multiple venues. As market crashes have shown over and over again, relying on a single or just a few venues can become a serious issue for banks as it prevents them from reliably trading client orders. Therefore, any banks should strive for diversified execution connectivity to multiple OTC desks, brokers, and exchanges to ensure best execution for client orders. So, as you can see, in crypto, the solution to best execution is not just about looking at what prices your client orders gets executed. It's the optimization, streamlining, and automation of the entire trading lifecycle. This is the only way to truly offer digital asset best execution for your clients. So what's the solution? Most of our competitors are fighting over an increasingly saturated buy-side market. We at AlgoTrader have spent years in specializing and understanding the challenges banks are facing. Our mission is to unify the entire trading life cycle with a fully integrated tech stack to enable banks to achieve best execution. Let's look at this a little bit more in detail. So what exactly do banks need to offer crypto custody and trading to their clients? In addition to the core banking systems like Avaloq, we will hear next, Finova, Temenos, and so forth, banks need an institutional-grade crypto custody solution to safeguard their private keys. Our partners, Metaco and Fireblocks, are some of the preferred providers for this. Then banks require an order and execution management system to handle connectivity to the various trading venues. Amongst our peers in the market, AlgoTrader has a full out-of-the-box order and execution management solution. And finally, and this is probably the most important piece here, you need an orchestration layer to coordinate all other components and automate processes like risk and liquidity management, pre-funding, management of client spreads, fees, reconciliation, settlement, hedging, and so forth. AlgoTrader is currently the only solution on the market capable of performing this sort of orchestration in an automated fashion. Now, there is one more aspect I'd like to highlight when it comes to supporting banks with digital asset trading technology. It's modularity and customization. As we have seen, every bank has a slightly different setup, different processes, different requirements, and there literally is no one-size-fits-all, at least not today. We have years of experience in customizing our platform for the individual needs of our clients, be it systematic hedge funds, market makers, asset managers, and of course banks. We have seen it all over the years. The modular approach gives our clients the ability to pick and choose the components they need for their particular case. And we then seamlessly integrate the system into their workflows, processes, and IT landscape. So, we at AlgoTrader have been assisting institutional traders for over 8 years. We currently serve 10 banks around the globe in implementing their digital asset trading offerings. In total, our product has been deployed over 120 times, either on-premise in the data center of the client or through our SaaS offering. And so if there is something we can help you with your digital asset strategies, we'd be happy to do that. This was it for me for today. I hope I was able to shed some light on the key challenges and entry barriers banks are facing when launching their digital asset offering. We look forward to partnering with you in your digital asset journey. Thank you.
Andy Flury, everyone. Yeah, I believe we have time for some questions if you're up to it, and if the audience is also up to it. Yeah, first off, thank you very much. It was very nice. It was also nice that you referenced the other speakers here as well. It was very cool. Yeah. Okay, so can I bring someone? Oh, there's one.
So hi, yeah, thank you, Andy, for this presentation. It was very insightful. So looking at the banks and the financial institutions nowadays who do crypto business, like FTX or eToro, who do derivatives, and others who do spot trading, or others who do DeFi and NFTs, what is, from your perspective or from your understanding, the highest demand from the bank side on products?
Well, today, you know, it actually always starts with spot. Usually, the top 10 coins, that's usually where it starts with banks. Then typically more coins are added. Next phase, I'd say, is derivatives. We do see a few of our clients also trading futures and options. Options, obviously, very interesting because it allows banks to basically structure products, ETPs, and structure products. So that's the next step. DeFi, I don't see that demand yet from banks. We have recently integrated DYDX, a decentralized exchange, just to get some experience. You know, how does that feel? Can we deal with a decentralized exchange in the same way we integrate with a centralized exchange? That demand is not here yet. I think it will soon. You know, from my view, DeFi, decentralized systems are not much different from regular ERC20 tokens. You know, an ERC20 token is a smart contract. DeFi products are essentially a decentralized product. And so for me, you know, every bank that trades an ERC20 token is already interacting with a smart contract. So the step to actually also interact with a DeFi protocol is not that big. Obviously, from a regulatory perspective, it is. Technically, it's not.
Great job, Andy. Thank you so much. Andy Flury from AlgoTrader. And yeah, I see you around. I guess you're here. If anyone has questions, feel free to reach out to him directly. Also, the online audience, you can use the Telegram group or the contact data that Andy just shared. We'll share the slides